How do capital gains taxes affect you when you sell your home? The answer to this question depends on a wide variety of circumstances, and you may be happy to learn that you may not owe any capital gains taxes on the sale of your primary residence. In this video, I'm going to tell you how, along with how you can roughly calculate your capital gains tax exposure, along with the tax rate that you might expect to pay. I'm Tim Hamilton with StellarQuest Real Estate. If you're thinking about selling your home and the capital gains tax aspect of the sale is important to you, I would highly recommend speaking to a CPA or tax attorney to get more specific advice on your situation. The information in this video is not tax advice. These are simply some of the general rules that apply to capital gains tax when you sell your home. If you want some more detailed information about the tax laws and rules, just let me know. I have a ton of different articles I can send you from a ton of different sources like the IRS, Franchise Tax Board, California Association of Realtors, and some others as well. If you enjoy watching this video, I would really appreciate it if you hit the like button below, and please subscribe if you like to stay up to date on the housing market. We do a lot of different market forecasts, market updates, and videos like this one just talking about real estate related topics in general. To start out, I wanted to quickly mention what I can do to help if you're trying to calculate your potential capital gains tax. I can provide you with a home valuation report to help you determine what your home might sell for if you were to list it for sale today. It is extremely important to start with an accurate estimated selling price, because if you don't start with an accurate number here, you're not going to end up with an accurate estimate of the capital gains taxes you might owe. The first topic I wanted to discuss is the primary residence exclusion you get when you sell your home, because this is probably the topic that most people are interested in. When you sell your primary residence, you are excluded from up to $250,000 of gain for a single filer and up to $500,000 for joint filers. In order to get the full exemption, you must meet certain criteria, and it is possible to get a partial exclusion as well. You must have used the home as your primary residence for 2 out of the last 5 years, and you can only take advantage of this exclusion once every 2 years. So if you're attempting to take advantage of this on more than one property, it is extremely important to carefully plan the sale dates, and I would highly recommend that you speak to your CPA or tax attorney to get specific advice on how to do that, especially if one of the properties was used as an investment during that time period. If you want to learn more about this exclusion, just let me know. I have a lot of different articles that I'd be happy to send you, so just send me an email. You can find that in the description below, and I can send you whatever information you need. So how do you determine whether or not you have a gain or loss on the sale of your home? What I'm going to be going through is an extremely simplified example of how to calculate your gain or loss. And I would strongly recommend reading the IRS guidelines on what can and cannot be included in these numbers, because in some situations it can get a little bit complicated. So to calculate the gain or loss, you start with your selling price, and this is basically everything you received in the sale of your home. Then you subtract your selling expenses. These are all of the costs and fees you paid to get the home sold. And then you subtract your adjusted basis. Now, the adjusted basis is basically what you paid for the home, along with some of the costs and improvements you made to the home while you owned it. And when you subtract the selling expenses and the adjusted basis from your selling price, that results in your gain or loss on the sale of the property. Now, I strongly recommend speaking to a CPA or tax attorney if this is a very important number for you to calculate, because they can really drill down and help you figure out what can and can't be included in these numbers. I also have a very detailed article from the IRS, and it has a very helpful worksheet to walk you through this process in more detail. So if you're interested in that information, just let me know and I can send that over to you. Now let's talk about the potential capital gains tax rate that you could be paying if you do owe capital gains taxes. And since I'm not a tax expert, I'm going to be reading some information directly from the IRS and Franchise Tax Board websites, along with some other information from the Washington Post. So to start out here, we're going to be looking at information from the IRS, which is your federal tax return. And it says here, the tax rate on most net capital gain is no higher than 15% for most individuals. Some or all net capital gain may be taxed at 0% if your taxable income is less than or equal to $40,400 for single filers or $80,800 for married filing jointly or qualifying widow/widower. A capital gain rate of 15% applies if your taxable income is more than $40,400 but less than or equal to $445,850 for single filers. And then for joint filers, the tax bracket for the 15% rate is more than $80,800 but less than or equal to $501,600. And that tax bracket also applies to qualifying widow or widower. And then there are a couple different income tax brackets here for head of households and married individuals who file separately. And then it also states here that a net capital gains tax rate of 20% applies to the extent that your taxable income exceeds the threshold set for the 15% capital gains tax rate. So that is for your federal tax return. And then for California, which is the Franchise Tax Board, it states on their website that California does not have a lower rate for capital gains. All capital gains are taxed as ordinary income. And then finally, there is a chance that you have an extra 3.8% capital gains tax that goes towards funding Obamacare. And then so here from the Washington Post, it states that an additional 3.8% tax applies to capital gains earned by individuals earning at least $200,000 or married couples earning $250,000 to fund the U.S. health insurance subsidy program known as Obamacare. So you add it all up, you have your federal, your state, and then if you're a high income earner, potentially this extra little bit on top to fund Obamacare. So if you are trying to figure out how much capital gains tax you might owe on the sale of your home, please let me know. I can provide you with a free home valuation report to help you determine what your home might sell for. And it is extremely important to start with an accurate estimated selling price, because if you don't start with an accurate number, you're not going to end up with an accurate estimate of your potential capital gains tax. If you're located outside my area of expertise, I can get you in touch with an experienced agent in your area. And once again, if you are trying to get a very precise picture of your potential capital gains tax, I strongly recommend you speak with a CPA or tax attorney. They can answer all of your specific questions and give you a much better picture of what you might owe. And once again, I have a ton of information and articles on this subject, so if you do want to learn more, just let me know and I'm happy to send you those. You can find all of my contact information in the description below.